Welcome back to the channel, everyone. Today I want to talk about Citadel Connect and why they're not classified as a dark pool and why they don't have to report transactions to FINRA. Trust me guys, you do not want to miss this video, so stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 2,600 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell if you haven't already so that you don't miss another video just like this one. And now I want to dive straight in with the key information. Firstly, I want to talk about what Citadel Connect actually is and why it's not classified as a dark pool. I then want to talk about what it is classified as and why they don't have to report transaction data to FINRA, and how actually, at one point, FINRA did actually try and make them report the data, but they fought back. Before dark pools, institutional investors had to trade in blocks of shares outside trading hours to avoid upsetting the market. Now, the utility found within dark pools is so high that some market makers have embedded them within their operations. There are certainly some benefits here in terms of increased liquidity, but there's another side of the coin as well. Through 2021, retail traders have uncovered significant short positions held by hedge funds in a number of stocks. Naked short selling is suspect by many retail traders to be involved. At this point, hedge funds have collectively lost $12 billion so far this year alone. One of the latest developments in this saga is Citadel Connect, a dark pool operated by Citadel Securities. If you haven't been following the Wall Street Bet saga across multiple Senate Banking Committee hearings, here's a brief recap. As the largest designated market maker on the New York Stock Exchange and accounting for 47% of US-based retail trading volume, Citadel Securities LLC also accounted for a significant portion of Robinhood's Q1 2021 revenue thanks to Robinhood's PFOF, or Payment for Order Flow business model. PFOF is a highly controversial practice because it tends to cause conflict of interests, which is why it's illegal in many Western nations, the UK, Canada and Australia. Current SEC Chair Gary Gensler noted some avenues for its abuse on the 9th of June. Payment for order flow raises a number of important questions. Do broker-dealers have inherent conflicts of interest? And if so, are customers getting best execution in the context of that conflict? Are broker-dealers incentivized to encourage customers to trade more frequently than is in those customers' best interests? In the same statement, Gensler further noted that around 9% of January's trading volume was executed on alternative trading systems, ATSs. These are commonly referred to as dark pools. Benefiting their moniker, dark pools have the effect of occluding the market's resolution. In stock market jargon, the aggregate quote reporting on the bid-ask quote spread, the National Best Bid and Offer, NBBO, is skewed, as noted by Gensler himself. First, as evidenced in January, nearly half of the trading interest in the equity market is in dark pools or is internalised by wholesalers. Internalisation means that the order is not routed to the market maker, but the broker itself fills the order from its inventory of shares, as in takes the other side of that trade. For instance, Citadel Securities had to pay a $22 million penalty in 2017 for misleading statements suggesting that it would provide or try to get the best prices it saw for retail orders routed by other broker-dealers. Basically, Citadel doesn't give you the best price when you purchase a stock. It gives it to you a few pence more expensive so they can profit the difference. Dark pools and wholesalers are not reflected in the NBBO. Moreover, the NBBO is only as good as the market itself. Thus, under the segment of the current market, nearly half of trading along with a significant portion of retail market orders happens away from the lit markets. And that there just proves that the order flow that comes from those trading platforms like Webull and Robinhood that is sold to Citadel ends up going through the dark pool away from the lit markets. Citadel Securities owns and operates one such dark pool out of currently 50 in the US called Citadel Connect. What is a dark pool and can it be abused? An alternative trading system, ATS or dark pool, is a private exchange that has liquidity benefits but can also obscure trades. Together with internalizers, they account for over 40% of the global equity market. Dark pools gained traction after 2005, following the SEC's adoption of the regulation NMS, National Market System. NMS modernized the stock market to make it as we know it is today. Therefore, dark pools are completely legal and regulated. However, they're also called dark because the orders don't show up on the exchange's order books. The obvious purpose for this feature is to stabilize the market, so that when large orders from institutionalized investors are placed, other market players are not alerted. Otherwise, with the order size in the open on the lit market, other participants will be able to trigger a downward price shift. By preventing that from happening, dark pools increase liquidity and market efficiency. Nonetheless, the same way dark pools eliminate transparency, by design, they can also obscure conflict of interests. And then it lists a number of firms that have been fined by the SEC for sketchy dark pool practices. The most common abuse found in dark pools is the so-called front running. With the knowledge that a trader is about to execute a trade, another trader can trade the stock first and then sell it to satisfy the original request at a profit. So is Citadel Connect a dark pool? Numerous reliable reports suggest Citadel Connect is indeed a dark pool. Interestingly enough, however, Citadel Connect is not registered as an ATS, nor does it report its trading volume to FINRA, which is overseen by the SEC. The features of Citadel Connect align with the purpose of dark pools. However, the SEC chair Gary Gensler differentiated between dark pools, ATSs, and off-exchange wholesalers. That leaves about 38%, most of which was executed by off-exchange wholesalers. Just 7 wholesalers accounted for the vast majority of this group, and we know the top 2, Citadel Connect and Virtu. Within the off-exchange market maker space, we're seeing concentration. One firm has publicly stated that it executes nearly half of all retail volume, Citadel. So Citadel Connect is actually an SDP, a single dealer platform. So what is an SDP? An SDP is not an exchange and it's not an ATS. Rather, SDPs have been defined as portals by which traders are granted access to prices from one dealer. They're very common in the FX world and started to appear in equities after the implementation of MiFID II. So who currently operates SDPs in the US? Citadel, Virtu, Jane Street, IMC and HRT. So are SDPs regulated like exchanges or ATSs? The short answer is no. According to a 2018 SEC comment letter from Virtu, the Commission specifically provided for an exemption from the definition of exchange to exclude automated trading systems of dealers, i.e., market makers and other dealers whose systems matched orders as an incidental part of the operation of the system. In other words, SDPs do not have any special regulations, but rather are just overseen by FINRA and the SEC, just like any other broker. So a single dealer platform is basically where you sell your securities to that single broker dealer, being Citadel, and you also buy your securities from that platform, being Citadel as well. With a normal ATS or even a normal exchange, it's just a third party that connects 2 people together, more just like a middleman. The difference here being that Citadel Connect isn't a middleman. You can only buy from Citadel Connect and you can only sell to Citadel Connect. Citadel Connect doesn't connect 2 people together. Our concerns: regulation and fairness. SDPs are not required to maintain a market and can cease operating their SDP at any time they see fit. So basically, SDPs can just pull the rug out from underneath you whenever they fancy. They're not covered by Regulation ATS or Regulation SCI and are limited to normal broker-dealer regulation. This lack of regulation for SDPs raises concerns about what they can and cannot do. For example, can they give their better clients a first look at their IOIs? Will clients who have a bigger research budget with a particular SDP receive preferential treatment? Will there be a liquidity profiling system, like some ATSs currently have, which distinguishes who they want to interact with? And will they back away from orders that respond to their IOIs? So something I found very interesting is that FINRA actually tried to make Virtu and Citadel report more data on their SDPs. But, of course, they didn't want to. They wanted to keep it hidden behind locked doors. So here's Virtu's response to that letter. FINRA is proposing to publish monthly aggregate non-ATS block size trading data for all NMS stocks on the same terms as current block size ATS data. Virtu supports this aspect of the proposal. Currently, FINRA aggregates a firm's volume with similarly situated firms for firms that average fewer than 200 non-ATS transactions per day. Obviously, Virtu is not supportive of this component of the proposal because they have way more than 200 non-ATS transactions per day. And finally, the real kicker, FINRA is also proposing to separately identify firms' volumes of trading through their single dealer platforms. In order to gather this data, FINRA proposes requiring firms to obtain a unique MPID for purpose of reporting trades executed on the SDP to a FINRA equity trade reporting facility. If a firm has multiple SDPs, it would be required at its own cost and expense to obtain separate MPIDs for each SDP, regardless of where the SDP activity is situated. Virtu is not supportive of this facet of the proposal and submits that its economic impact was not correctly evaluated and considered by FINRA. Obviously, Virtu doesn't support this part of the proposal and says that the economic impact was not fully considered, because if they have to publish all of their data to FINRA, they're going to be screwed because everyone's going to know what sketchy stuff they're doing. This next paragraph then did make me laugh because it says Virtu is a strong proponent of marketplace transparency. But guys, we don't want to report our data, but we love transparency though. Trust me. Virtu is committed to transparency in the marketplace. For example, Virtu provides its clients with information and analytics that clients need to assess execution quality. With consistency practiced what we preach in supporting marketplace disclosure enhancements by providing our clients and the public with greater levels of order handling information. But we're still not going to disclose our transactions. Virtu is not supportive of FINRA's proposal to publish information regarding trading through a firm's SDPs. As previously stated, Virtu is not supportive of this facet of the proposal and submits that such a requirement is inconsistent with the concept of an SDP as articulated by the SEC and potentially has detrimental economic effects that have not been properly evaluated and considered by FINRA, because it would screw Virtu and Citadel Connect. Both ATS data and market maker data are already published on FINRA's website. Virtu does not see the benefit of artificially segmenting a market maker's business activities to create a category of data whose benefits are unclear. Further, Virtu does not agree with FINRA's assertion that expanding transparency to all segments of the OTC market would bridge gaps in information between ATS versus non-ATS segments of the OTC equity market and reduce any competitive distortions that may be associated with information gaps. Basically, they're saying that if their data is released, they're not going to be competitive anymore. Boo-hoo. Stonks Batman also noted that Citadel Connect's platform awfully sounds a lot like a spoofing platform, wondering why Citadel Connect isn't registered as an ATS. Also, not saying they're spoofing, but it sounds an awfully lot like spoofing. An immediate order to cancel order is an order to buy or sell a stock that must be executed immediately. Any portion of an IOC order that cannot be filled immediately will be cancelled. That was the definition of Citadel Connect's immediate or cancel platform, and here's the definition of spoofing. Spoofing is a form of market manipulation in which a trader places one or more highly visible orders but has no intention of keeping them and subsequently redacts that order. Guys, be sure to let me know down in the comments below what you think about Virtu not wanting their SDP data being reported to FINRA. And if you want to pick up some shares in AMC, but you haven't even yet signed up to a trading platform, be sure to sign up with Fidelity, because they don't sell their order flow to market makers like Citadel, who pass that order flow through the dark pool. Therefore, don't use Webull and Robinhood, because they do sell their order flow. Although saying that, Webull is an excellent beginner investment platform. They've got good charting, they've got news, they've got company fundamentals, they've got option order flow, they've got the lot. So if you do want to sign up with Webull and you're in the US, be sure to use my link down in the description below. Or if you're in the UK, be sure to sign up with Freetrade, again using my link in the description below, because they also don't sell their order flow. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!